Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty and doing our weekly market update. I just wanted to share my screen with you here and jump right in on what's happening with the market. Whoops, can't give you that sneak peek yet. I'm just going to take this right off of X. This is from Bill Pulte with Fannie and Freddie Mae, FHFA. He has basically sent in criminal referrals for Jerome Powell, the chair of the Federal Reserve, for his testimony, alleged perjury during his congressional testimony. Uh, Rep. Anna Paulina Luna is facilitating that along with a couple of senators so far. There's probably more jumping in as we speak. We may see a resignation from Jerome Powell before his term is up in May. We'll have to wait and see. Or if there's obviously something that was criminally done there, um, then the president would certainly have cause to fire him, even though people have been saying he was going to fire him, was he not going to fire him, what would it do to the markets, da da da. Well, if there's an issue with this building project, it comes back to this $2.5 billion building project, which they're calling it the Jerome Too Late Powell's Taj Mahal. Um, it's seems excessive, and Bill Pulte, of course, is his family is in with Pulte Homes, along with Donald Trump, who are both builders. I can tell you myself, that seems pretty excessive, and some of the things that they're talking about that were proposed for it, like rooftop decks and kind of entertainment areas, seems to be a bit ridiculous for the type of work that they're doing along with the staff that they have there. Um, you know, I think President Trump said it best. He's got one of the easiest jobs. Now, if you screw up, like he's done more than once on many occasions, um, and going all the way back into the first term of Trump, um, you've got issues there. And then again in 2022, he was late to the party. Kept saying it looks like it's transitory, and he's late now. I mean, at the very least, a lot of people have even been asking Jerome Powell lately, why aren't you at least at a neutral policy? I've heard even different talks he's given where he's taking questions or press conferences lately. He's been asked this question: why aren't you at least at a neutral policy? Neutral policy for the Fed rate right now, they're at like 4.25 to 4.5. And it's, it should be more like a neutral policy would be more like a 3 on the Fed's fund rate. And that Fed's fund rate, the bond market's always ahead of the Fed, but it's based on what's going on in the economy. And it also is based on very specifically what the Fed policy is. Yes, the bond market's ahead, but it's based on what the Fed as a whole, especially, what the chairman, who's the biggest mouthpiece, is saying their policy is. And they're admitting to us, he's admitted to, I've talked about it many times on here, he's admitted they're being very restrictive, and there's more and more Fed governors that are calling, for cuts. We'll get into that, but right now you've got Kevin Warsh coming out more and more. You've got Christopher Waller coming out more and more. Bowman, that yeah we should now with Powell in there, we probably won't see any rate cuts in July with the current Fed policy, okay, with the restrictive policy. And the big argument is, I know a lot of people, they want to argue about, well, you know, this is how, inflation is being, uh, uh, you know, taken into consideration, and this is the way it's been done since the 80s or 70s, whatever. And you get into this back and forth with people. Sometimes you get questions on we have this or that, but a lot of people more and more are saying the Fed should lower the rates. You got to understand these indicators that you see in the headlines all over the place. Okay, are typically rear view mirror, old, very old data because giant percentage data points from those sectors that they're getting this information from. And they don't even run this stuff like they used to. Now they figure, for instance, shelter, which make up like, let's say around, depending on which report you're getting on inflation, there's PCE, which the Fed really hones in at, and then there's CPI and all these other, inflation points. But the shelter portion is like 36%. In the PCE, it's like 18%. In the CPI, it's much higher. But in any case, it's all rear view mirror because, for instance, with shelter, the way they look at it, they look at rents. You would think, what about the housing market? What about where mortgage rates are? They don't look at that. That's not part of their mandate, which again is part of the disconnect. Okay, compared to how they used to gauge inflation, because you thought we had high readings when we had the Biden inflation at the 9%, over 9% mark. Using the old indicator data that they used to use, like back in the 70s, we would have actually had higher readings, probably double that. Okay, where they used to take some more of these things into consideration. My point is, if you look at data readings that take more data sets in the app at like the right now today, what is the today inflation rate, not what it is year over year, okay, but or even month over month, but what is it right now? Where is inflation today? Like if you use a site. And you can find it on X or online. It's called Trueflation. They take way more data points. I mean, like millions of data points versus maybe a few tens of thousands data points to break down all this information. A lot of this stuff right now is even done by AI. With the way the Fed does it, but it's very antiquated because it's looking backwards, and they're not proactive at all. I mean, with Jerome Powell's thinking, and some of the other people who are afraid of people getting married, having kids, and trying to buy homes and buying stuff, which they think, oh, growth, it's not good if we have growth. I mean, literally, they've actually said things like this. Um, Neil Kashkari, I think that's how you say his name. He's actually said things along these lines, one of the Fed governors. And it's like, what, guys, this is part of life. People are gonna, that's part of what they do. They get married, they have kids, they buy houses, they have more kids, they buy bigger houses. Later on, they downsize, and they buy stuff for the house so that that whole ecosystem around that house, whether it be going to Home Depot, going to the grocery store, going to Home Goods, all these things kind of, whether they're using a handyman or a construction person putting in a pool, whatever the case may be, landscapers, all those things, help our economy in that whole ecosystem. So uh, they don't like that. I mean, they literally has that this whole thing that started late in 2022 has now since then has basically put a hindrance on new supply. What does that do? That hinders, okay, new supply of new homes, new single family homes. That hinders, now puts an upward pressure on pricing. Okay, because real true new inventory are new builds, typically single family homes. Okay, now some may argue, and it certainly would make sense maybe to go back to maybe an older model there, maybe build homes, starter homes that are truly more of a starter home, maybe some 2 or 3 bedrooms, or at least the square footage is maybe around 1,000 square feet, 900,000 square feet. Maybe that makes sense, with only 1 or 1.5 baths, for a true starter home like they had back in the day, where for a while there, our starter home square footage was a much bigger footprint. Okay. Um, and some people argue that that may be a way to go for a while to kind of dig ourselves out of this, predicament that the Fed has put us in. But the Fed is supposed to be sure, because they're supposed to be disconnected from the government and not working, right along lockstep with the government. That's what we hear all the time. But if that were the case, Jerome Powell would have lowered rates much sooner. But without even getting into all that, which we've talked about ad nauseum before, this whole debacle here is something that I took a note here. The Brew Khalifa, the tallest building in the world, um, I believe that's in Dubai. Dubai. It costs $1.5 billion to build from the ground up. 1.5 billion, the tallest building. If you ever seen it, it's absolutely gorgeous, beautiful. Um, you know, uh, Feat of architecture, and they're trying to spend 2.5 billion on a renovation of the Federal Reserve. Now, without getting into the weeds of it, people will say, "Well, the Fed's disconnected, and that's their money." And da da da. No, 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 no. Without getting into it too in depth, you know, yes, there are a separate entity from, they're not a federal agency, but they work with federal agencies, and they are the ones that, basically print the money. And when they're working in conjunction this way, there are costs that our government, which they're doing, is basically doing an audit of this fiasco. And they're going to find out, exactly. Let me just make sure I'm running. Okay. They actually are going to figure out what's going on here, because there's some that have that this doesn't sound right. Allegedly, so there was some perjury, and where's all this money actually going to? Is it going for some sort of mismanagement, somebody's brother doing the construction, all those questions. So, anyways, this is happening. Wanted to bring that to your attention, and this is going to be something I think that's going to maybe get Jerome Powell moved out of there before May, which is when his term is up. Thank God. Anyway, moving on to the housing market. There were there were some encouraging signs over the last week, where mortgage application data was rising up to 9% as a weekly average. It dropped to 6.67%, the lowest level since April. Touring activity is up 25%. Google searches for home sales are up, which we talked about last week. And But again, the builders break more ground, but not on single family homes. And this chart, basically, in a nutshell, shows that. And this is a big problem. Okay, this is a very big problem. So, looking at this a little bit more in depth, privately owned housing units authorized in permit issuing places, total units. You can see how this is dropping off. Again, that's your new inventory. That's what's really going to help offset some of the affordability issue on price, not on interest rates. But part of this is due to, obviously, a big part of this is due to the interest rate, late interest rate, too high and too late interest rate hikes by the Federal Reserve, by Jerome Powell on the Fed's fund rate, which affects the 10-year and Treasury and bond market, and then affects mortgage rates because they go hand in hand. There's usually 175 to 200 point split on that, and that's been higher since the crazy inflation we had over the last 3 or 4 years. Those spreads between the 10-year Treasury and mortgage rates have gotten much better, but they're still not quite at that 175 to 200 range. Builder application survey, again, you can see that dropping off. And the entire idea of builder sentiment way down. Okay, builders are marginally more optimistic compared to June, but you can see how all this is trending in a downward direction overall. Okay, so why might they be a little bit more optimistic? Maybe because people are thinking, well, we've got to wait till May, uh, for the policy to change, and maybe for things to get more into 2025, not antiquated models, not antiquated way of reading things, and getting on point with the curve, or maybe even ahead of the curve on things. And this is why I bring this into this a lot, is this building construction. This is kind of becoming a flatline issue. We're going to kind of have to see how this goes over the next, you know, and we're going into the part of the year that's obviously slower for home sales, unless you're, in a seasonal market or seasonal neighborhood, which we have here in Phoenix, in the greater Phoenix area. But the reason why this is big is, manufacturing and residential construction is usually your two biggest indicators of, and we've already had manufacturing issues leading up to this point where we've lost manufacturing jobs with, and we're just getting out of the last administration spending and budget, bills, basically, because we just had the big beautiful bill. Again, not perfect, but I think it's going to be better. But my point on this is, this building and construction before recession, you can see the recessions in each line here. We see that, residential construction drops off. So we're just starting to flatline now. Some of the sentiment is kind of mixed bag or horrible um, from that standpoint. Um, so we'll have to see. Overall, we had a decline in jobless claims by 7,000. We're at 221. The funny thing was, and this isn't necessarily, some of it may be offset by military, some of it offset by state government hiring, but the government actually offset in the higher category than private sector for overall employment. So overall employment was actually better in the public sector than in the private sector, in other words. Um, so we've had federal losing jobs, but state gaining jobs overall. If not, we'd be having a totally different conversation on the unemployment rate. So just FYI, the private sector, again, shows signs of weakening, but hasn't been broken yet. And Jerome Powell moved the football a couple of years back and said, yeah, inflation. We stay with inflation, and we our policies on with inflation. But then he said, wait, no, we have to get a higher unemployment rate. Now, their dual mandate again is inflation, and their employment, full employment. But now he's moving the goalpost even higher to a 4.5. Uh, 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 Unemployment rate is basically what you want to see, or 323,000 people unemployed is probably where, for him being in there, you'll see a move until he breaks the labor market. Jerome Powell, isn't gonna really budge. And Bill Pulte says here, uh, where is it? Yeah, they're visiting the federal building next week, and some of these. He says, I believe Jerome Powell is conducting economic warfare against America, and more people are saying this is totally political, because you dropped the Fed's fund rate before the election when inflation was higher, and now you won't. And it wasn't like the job market was at these higher levels that he was talking about. There was just, the only thing that had changed was really that there was an election, um, and he had some big rate cuts then. Um, but again, just to show you the power of the Fed and why I say 65 to 75% is where our, from the Fed's policy, Fed's messaging affects the bond market. When they got up to 5% Fed's fund rate, they said, we're not raising any more. And then we had a huge drop off, okay, to like 3.8 on the Fed's fund rate. So just bond market's always ahead, yes. For the people who want to argue with me out there, I don't know what they're not getting. That messaging, that policy, even before they get to doing something, will affect the markets. Yes. Okay. Duh. But their policy, their messaging, and their final, lowering or raising of the Fed's fund rate in the direction that they've messaged that they're heading, and the data points that they said will set them off either way, are affecting 65 to 75% of the Fed's of the bond market and in such the mortgage rates. Okay, because the bond market, 10-year Treasury goes hand in hand. Okay, the inflation rate. Okay, so I wanted to show you that this is an old report from June of 2024. Okay, so they were last year, because you look at it year over year, you get a lot of these headlines, a lot of this clickbait. um, just gonna, let's just say a lot of haters out there, who maybe don't agree with a lot of things in the current administration, that just or to just want clickbait. They were at 3% this year. Okay, just to make this real easy, 2.7%. Okay, so yes, month over month it was up, but year over year, okay, and for the entire year we're trending down overall, okay, for inflation. So year over year, again, is the biggie for, again, what the Fed would look at, what the bond market's looking at, and um, again, we have to kind of look. One report doesn't really do it, and some of these reports are also, you have to understand too, seasonal. So there's a lot of misinformation out there online. One other big deal is this PPI report. This says wholesale inflation measure was unchanged in June. Well, that's the headline, but look at this. Okay, because there's other headlines out there that are correct, that are saying so far from the, now all the tariffs haven't kicked in. So what's going to be our true measure? We started in April 1st, but with the tariff, boogeyman from Powell. And by the way, again, I'm going to just say, if tariffs automatically equated into inflation, which the only thing that causes true inflation, okay, not a one-time price adjustment with a tariff, possibly, if it's not eaten by the wholesaler or the person who's importing it into the U.S., uh, it is too much money chasing too few goods. In other words, the government, the Federal Reserve, Congress, power of the purse, and the Federal Reserve going along with it, printing too much money. Okay, that causes inflation. Okay, not enough growth with what you're spending, just like any household, causes issues, causes debt, causes this inflationary factor. It's an inflationary factor every time you go to get a car loan. So, you know, some of these data points, again, I think we're going to see a lot of changes from the new Federal Reserve person, chair, and governors that are in play. I think we're going to see a lot of changes in getting rid of a lot of the antiquated ideas, antiquated models. We're going to be more in the now. Not that we're not going to look at where we've been over the last month and year. Of course we are, but I think you're going to get more into the now. So the import price index, though, which way is that sloping? Can anybody tell me? Yeah, it's going down, right? So if tariffs up to this point, now usually, um, you know, they'll say 2 to 3 months for any kind of supply shock or tariff issues. What you'll hear out there. Okay, well, April 1st, you got May, or I'm sorry, April 2nd to now. So you got May, June. We're in July. Okay, so this has been going down. Okay, and what's happening behind the scenes is a lot of these people or companies, that are bringing in their goods. A lot of them are eating the cost, but to offset their costs, they're also renegotiating the hyperinflation they had from COVID, um, with their wholesalers for their goods, okay, or resourcing to get it from somewhere else to make their product, okay. Again, if tariffs automatically meant inflation, other countries, look at China, they have tariffs. All these other countries have tariffs. They would all have inflation. Okay, they would all have inflation. Post or pre COVID. Okay, just in general, They would, and it's not happening. Matter of fact, I believe last time I looked, it's been a couple weeks actually. I should have looked at this ahead of time, but China actually had deflation recently. So it's just to automatically just say here the causes, and there may be a one-time price adjustment, possibly if it's not getting eaten by the supplier. But the other thing to remember is now we're able to export there to these other countries. It's also important to remember some of this is about stealing of intellectual property. It could be national security matters for things we need, rare earth minerals, steel, whatever. Um, and the the other thing that's important to keep in mind is these other countries are getting their prices down from their suppliers. So let's make sure we're not going with the tariff boogeyman. Okay, so one other thing on that is August 1st will be the tell. Okay, because that's when all the rest of these are supposed to kick in. There could be a few negotiations here or there by a couple weeks, whatever. But August 1st is supposed to be it, and then the letters get sent out. But with those tariffs, keep in mind a couple of things. What to look for. We've already got a framework of a deal with China. Um, the one to look for is India and Japan, I think. And we just had Indonesia. We've had others already come in. But there's really 15, 18 out of all these over 100 um, trading partners. There's really about 15 to 18 that are super, super, what you'd say maybe more vital or important that we're not necessarily onshoring enough at this moment. A lot of it has to do with tech stuff like, or rare earth minerals. But they're starting to open these rare earth mineral mines and other trading partners here in the U.S. They're also starting to uh, onshore some of this. Obviously, we have the chips factory here. They just made a huge other additional investment in that from Japan. Um, so a company from Japan, I can't think of the name of it off the top of my head, but there's a lot of additional uh, this additional tech. I think it's 15 trillion already that's been invested in the country. So a lot of this has to do with tech. The reason why I bring it up is again, it's all of this boogeyman stuff that we keep hearing in the media. So with the tariffs, keep in mind there's really just those handful of countries. Take a look, keep an eye out for India and Japan. Those are going to be two key ones, and August 1st. Okay. Now, from that point, if you want to say, okay, well, we'll see from there. Okay. So then you have, okay, so all of August, September, maybe October, that will tell the tale. We're not probably going to get a rate cut with too slow Powell in July. So we'll see one. They're forecasting. We'll probably see one, probably 25 points if he's still in there by September, October, and then another one before the end of the year. And that was already priced in with or without the tariffs. That's just two Fed rate cuts, probably 25 basis points each, and then we go from there. And in May, he's gone anyway. I think you'll see some huge slashing. A lot of by October, you're already starting to see it with Kevin Warsh getting out there and Christopher Waller and Bowman doing a lot of interviews out there. And I think the whole shadow Fed thing is going to be huge with them basically saying what their policy is or will be once he appoints somebody ahead of Powell's resignation, firing, whatever, or if he has to do that immediately, that's obviously going to be a huge shift. Now, Trump is saying he wants to see the Fed rate 300 points lower or 3 points lower. So that's part of the art of the deal where he usually goes a little bit higher than but you never know. Maybe he'll want somebody to go that high. I think probably you'll see somewhere in the middle of that, really. And I think that would really make a huge amount of sense to at least get the neutral. If these tariffs don't do what the boogeyman people are saying they're going to do, you could go even lower depending on where we are in the economy at that point. But anyways, that's where we are on that. I just wanted to make sure, kind of clarified some of that stuff because there's just a lot of crazy talk out there, a lot of headline nonsense, and It's just really uh, drives me nuts sometimes. But the thing to remember is the construction. That's a big key, and that's sentiment and permits and what's going on there. And then when we start seeing that construction labor uh, construction people getting laid off, that's going to be a huge indicator. So we keep a close eye on that. Okay. Um, all right. So 10-year treasury, 4.4 right now. Let's see. Get that a little refresh. Just see where we are here. 4.4. And then, so again, traditionally we should be at about 6.4 at the most if the spreads between a 10-year where they would normally be, or 175 points higher. Right now we're at 6.8. So you can see where those spreads are a little off, but those spreads, if they were where they were just a year, a little over a year ago, we'd be at 8% right now, where we are in the high sixes on a 30-year average. So that's much better than it was. Just getting the spreads better and the economy back in line, um, that is going to be just that alone is going to be huge. Also, we'll see how these regulations go with the SLRs that Scott Bessett was talking about over the summer into Labor Day. We should see the effect of that, where basically these banks don't have to have that extra reserve funds in there. That should help open things up a bit, maybe bring it down about another 50 basis points or so on for mortgage rates. And again, these are just averages. You can get better rates than this if you're BA, FHA are a little bit lower. Obviously, you can get rid of PMI with a conventional. There's all kinds of. You can get right now half the about 40% of the builders are giving, are doing price reductions out there. About half of the sellers or builders, if not all builders in some areas, are giving some sort of concession, whether paying for closing costs and or buy down rates. We've got one right now. I'll show you here in a minute. It's like 0% down, $500 move in, plus they're buying the rate down. There's another one that's 5.75% interest rate, no money down, $1,000 earnest. I mean, it's just they're builders just have to keep their inventory going, but they're going to be definitely slowing on their starts. So, but the good thing is we still see overall, although there's been a little bit of a dip off, but a lot of that is seasonal. Um, we still see for the year mortgage application data is good. So whether those are sellers that got pre-approved to buy, um, and they did or didn't sell, there'll be people who probably want to move on either later this year and relist maybe in the fall when we get through some of the boogeyman turbulence, as I like to call it, with the tariffs and Federal Reserve and the 10-year and the rates and all that. But we'll see how that goes. Right now, rents, we got an elevation in rents. As far as inventory, our supply has gone down a little bit. Right now, let me pull this other chart up I've got here. So, uh, right now we've got 82 days, closed days on market, 5.17 month supply. We've got 25,000. So the active listings are actually down a little bit again this week. They were down last week. The pending is down, and the closed units is down. Again, seasonal, not surprised, and with the ridiculous, still high, elevated mortgage rates. Again, we know if we get to 6%, we know things will really pick up on those rates, but we should at this point be lower than that. With being at a neutral policy, let's wait and see what's going to happen. Well, let's be at neutral then. Um, Absorption rate 19. We usually like to see that another 10 to 15 points higher on that. Average list price to average sales price. This average sales price here obviously runs off of what the inventory broken down here by price points are. That's a big part of that. So sometimes don't read too much into that, because it does depend on inventory, seasonal, time of year. A lot of that is also hyper local. So this close days and pending tells us, we definitely have a little less going on in the buyer pool right now. Or, maybe people will pick back up after school starts, or they'll just wait till the spring. Okay. Depending on, what their situation is. A lot of the retirement people, obviously, they're going to be moving fall, winter when it's cooler. Supply index. Okay, so that's 104. Our demand is at 76. Again, both of these, the supply is actually pretty good. That's a nice balance range. Demand is down. If these two numbers are the same, this number would be at 100, which would give us a balanced market. Between 90 to 110 is a balanced market on the index. And overall, if you're at 90, if you're below 90, it's a buyer's market. Over 100 is a seller's market. Right now, overall, we're at 72, which puts us overall in the greater Phoenix area in a buyer's market. Across the country, the median home sale uh, price is 400,000. That's the first time it broke that. So the price is actually still going up. We're not seeing huge gains like we were during the crazy years, obviously, but nevertheless, we're seeing that sort of thing. So here's some of the other deals right now that are going on. I just wanted to quickly show you this for first-time home buyers who are having issues. We're seeing about half the first-time home buyers right now in the buyer pool. Rates drop 1% or 100 basis points. We'll see, 5 million more people can enter the housing market that couldn't enter before because of affordability. So this stuff's really important right now. 5.75 interest rate. Remember what we were talking about over here? We were talking about, and again, for the FHA, this average is 6.3. So that's really good, okay, for what's going on right now. I know affordability is tough, but for what's going on right now, to get 0% down and get that interest rate, that's pretty good because usually with down payment assistance programs, they're typically going to be higher fees, higher rates. Maybe they take a little bit longer to close and all sorts of things. So that's a pretty good deal there. And then here's another program we have that's could be used for anything: resale, new home. Is 1% down. There's 0% down programs out there too. Again, depending on conventional, FHA, whatever. But this you could use on any property. The other one, Chinoa, actually is can be used anywhere in the valley too. But this is another one, 1% down. Their discount mortgage insurance, quick approvals, and close 3 weeks or less. Must not owned a home in 3 years. That qualifies for first-time home buyer, by the way, if you haven't bought a home or owned a home in the last 3 years. And a grant of 2% up to 7,000 is given, no repayment needed. So there's just a couple of ways. Again, you can do assumables, where you can assume somebody else's lower interest rate. There's a lot of ways to get a lower interest rate right now, get a deal on a property. We could definitely get price reductions, but more importantly, we could get these other deals where you can get a lower interest rate, even with that 0% down, um, or get buy down rates that are fixed on a sale. We've got somebody right now we're looking at doing VA with. We're probably going to need about 10 to 15 grand for their closing. It actually would help them to pay off some debt, and it would be something that you could do too. Yes, that's something you can kind of work into your concessions, where it basically helps you with your payment. So there's really a lot of options out there right now to get those lower rates, to get maybe some debt paid off in a deal, to get closing costs taken care of, down payment taken care of. We can get into all the different nuances there, and different options, whether it be new or resale. If you're thinking about selling a property, obviously, we're just going into a slower time of year, but we can definitely get you the best deal possible. Right now, you just want to make sure that you're pricing for the now, not what happened to somebody 6 months or even a year ago. That's going to be a little out of date, just because of where we are right now in the market. But you can still look at it as well. I'm still moving on, and I can get a fantastic difference in a deal on my purchase. So it doesn't matter when you're going to be, uh, buying, trying to time the market. Can you afford it now? Can you do it now? And buying a home, if you're going to be there at least 3 to 4 years. But once you get into that fourth to fifth year, you're looking at really gaining some equity, getting some tax advantages, just a lifestyle difference of owning versus renting. And that gaining that equity and being an owner is really a big deal. So uh, guys, if you have any questions at all, feel free to reach out, and we'd love to be able to help you with anything you have, whether it be home evaluations, getting involved in starting to buy a home, whatever the case may be. We would be happy to help you in making sure you're getting the best value for your time and money. We'll talk to you guys soon. Thanks.